For many years, we investors have admired or at least studied Warren Buffett, his way of investing, how he has achieved it to learn how he did it so we can do it as well. Warren Buffett, who is considered by many to be the most successful investor in history, rarely changes his investment strategy, which he focuses on the long term. Even in a bad economic times or situation where the market is down, he maintains a strategy and believes that this is a time of opportunity to buy good companies at a reasonable or better price that we have not seen in a long time. And although we do not want to believe it because it seems like a boring strategy, it has worked quite well for him, and it is the one that I think we should analyze. So in this video, I want to talk about Warren Buffett's investment philosophy in depth and how he selects the different companies that he invests in. Warren Buffett focuses more than anything on the quality of the business instead of the prices of a share in the short or medium term, focusing on good fundamentals of the company and the intrinsic value of the business instead of the price of the stock itself. He usually restricts his investments to companies that he can easily analyze and understand, which I think is quite important, since one of the most important investment rules at this moment for me is to only invest in what we really understand. Otherwise, mistakes can be made easily, investing just for the sake of it or because we think the industry will do well without fully understanding it. And believe me, it's an easy way to lose money on the stock market. That is why they say that Warren Buffett did not suffer significant losses during the dot-com bubble, for example, in the 2000s, since he said that he did not understand technology much at that moment. Even today, Warren Buffett does not invest in Microsoft, for example, due to his lack of ability to understand technology and also because of his relationship with Bill Gates, but he has always said so anyway. Another pretty important thing that Warren Buffett focuses on is enduring competitive advantage in companies. What he means by this is that the company has to have a significant market position over its competitors, which prevents competitors with a lot of money from overtaking the company. Like, for example, his biggest investment, Apple. Warren Buffett has said it before several times on several occasions, and I have mentioned it in several videos. Apple for him is not focused on the iPhone itself. What strikes him or what he likes about Apple is the recognition, the brand recognition that the brand has worldwide. Even Apple is the most recognized brand to date worldwide. And both that and how Apple does to make its customer feel special and productive with their ecosystem, that's what Warren Buffett focuses on when we talk about competitive advantage from Apple. But every company needs to have their own competitive advantage. Apart from everything I mentioned, he has always had in mind and has always shown other several important points to take into account or consideration when investing in a certain stock. First and foremost, understand that the world economy is complete and unpredictable. As we have always talked about in the channel, it is impossible to know what will happen in the next few months or few years in the economy. The other day, someone asked me that if the S&P 500 usually has an average return of 11 or 8% per year, but the last decade was about 17% per year, it could mean that the next decade will be a bad one and it will start to fall or be almost static. And the truth is that it is impossible to know, although there are sayings that show us that the US economy normally lasts 10 years growing and outperforming all other economies, and the next 10 years usually outperforms the European economy, and then the US returns to outperform the whole economy. It does not mean that it will continue to be so, since many things can change and affect the performance of the United States of America, United States of economy, or internationally as well. The same goes to companies and stocks. The fact that Nvidia has had a return of 11,000% in the last decade does not mean that it will have that same next return in the next decade, since too many things must be taken into consideration, such as the fact that the last decade has been the highest technological growth we have ever seen in the industry. NVIDIA has seen the biggest expansion in the last decade as well. That does not mean that it will continue to see that same return as a stock and as a company for the next decade, or not, as it may or maybe not. Like Warren Buffett, he also shows that the economy and the stock market do not always move in sync. And the most important thing about why he focuses on investing for the long term is that, according to him, the long-term performance of the stock market cannot be matched anywhere else in another investment. Now, apart from all those general approaches to investing, Warren also has certain criteria that he looks for in companies. The first one is that the candidate company has to be in a good and growing economy or industry as well, or good and growing, both criteria together. There are companies that are in a growth industry but not in a good economy, or vice versa. The second criteria is that it must enjoy a consumer monopoly or have a brand in charge or a competitive advantage, customer loyalty, something like that, as we are talking about Apple. The third criteria is that it cannot be vulnerable to competition from anyone with abundant resources. 4, the earnings should be on an upward trend with good and consistent profit margins. 5, which companies should enjoy a low debt to equity ratio or a high earnings to debt ratio. What it basically means is that it must be in a good shape and economically and financially stable, that the debt cannot be turned into a problem in the future. 6, it must have high and consistent returns on the invested capital, since it is the only way to know that those who manage the company know how to correctly manage and invest the company's money. 7, the company must have a track record of retaining earnings for growth. 8, you cannot have high costs of sustaining operations, high capital expenditures, or falling cash flow, since that, like high debt, can bring many problems in times of crisis. 9, the company must demonstrate a track record of reinvesting earnings in good business opportunities, and its management needs a track record of earning from these investments as well. And finally, the company must be free to adjust prices to inflation without the customer or anyone else complaining, since otherwise costs could increase very quickly thanks to inflation, which would make the company not comply with point number 8. Here I leave you the screenshot of the list of criteria in case you want to take a picture and use it when analyzing a new company to invest in. Still, in conclusion, Warren Buffett does not focus only on buying when the market is rising, as many do. In a recession, he buys millions of shares of solid businesses at reasonable prices. He does not buy stocks just because of FOMO or because they are stocks that have had good growth, like technology in the past decade, for example, unless he really likes it a lot and sees it at a good price, like Apple. Now, aside from him being selective during a bear market when it comes to investing a lot of money, one benefit he has that someone like you and I won't have right now is his ability to get an even better deal at a better price or better dividends when investing in those companies that we average investors might not have for many reasons. Now, how did he do all this? He started saving, investing at a very young age, reinvesting that earnings, finding a mentor, and living within his means, just like he dedicated himself to focusing on a single long-term strategy without looking for ways to make a quick buck. So if you like this video, I'll leave you here another very interesting one and here for you to subscribe. Thank you and see you next time.